Today we're going to be talking about risky investing versus diversification. And you can see we've kind of themed this around the movie Risky Business because, depending on your investment strategy, investing can really be risky business. And so we wanted to look at a few situations and see how they played out historically. And why are we even doing this webinar in the first place? Well, we've had a few clients reach out as of late that were wanting to get more into tech or more into gold or more all into one sector. And while that might look really good over the short run, depending on what factors are at play in the market, our goal is to try to take a step back and see how that might look over the long run and how smart you might look if you do go that aggressive, kind of riding the trend up, or versus a diversified investor. So let's go ahead and get started. All right, so we want to start by looking at a few scenarios where there was some irrational exuberance or some excitement in the market. And the first we're going to look at today is the real estate bubble. I think we're all very familiar with the scenario that played out in 2008, but it's important to remember from the beginning of this century until leading up to that crash, real estate was the place to be. Real estate was absolutely killing it. And so we saw, people on every Saturday morning, you would see telemarketers or people on these infomercials talking about zero cash down flips. You don't even need to put your own money into the deal. You can triple, quadruple, quintuple your money in these real estate deals. And we saw the housing market for years just go up and up and up. And it looked like there was nothing that could stop it. So what we wanted to look at is, let's see how a real estate investor did over that time period. And so what we see here is we're comparing a balanced investor and a 60% stock, 40% bond portfolio, well diversified, to a real estate investor. So in this case, we took the real estate.
Hey, Matt. So sorry, your PowerPoint is not changing on our end.
Oh, my bad. Let's see. It appears our PowerPoint's not changing. Let's see if we can troubleshoot that real quick. Now, are you guys seeing that slide? Awesome. All right. So as I was saying, the real estate market was absolutely on fire. The Saturday infomercials, and it seemed like nothing could stop it. Here was the slide we were looking at together. The real estate investor versus a balanced investor. That's 60-40, well-diversified portfolio versus someone who was all in real estate. And so this is for the 7 years leading up to the housing crisis. So some really good years for real estate. And what we see is the real estate investor did exceptionally well. They really outperformed their colleagues who were in a well-diversified portfolio. The colleagues over that 7-year time period only made around 4.2%. While they were making 16% a year. They were absolutely killing it. But we all know things didn't carry on that way forever. What happened next? Well, leading up to the great housing crisis, no one could have seen it, but a bubble popped and the housing market went into free fall. And so that real estate investor who killed their colleagues in terms of performance over that 7 years, well, how'd they do the next 7 years? How did their brilliant strategy go? Here, we're looking at that same real estate investor versus a balanced portfolio over the next 7 years. And what you see is, granted, the balanced portfolio only beat over the next 7 years by about 2 to 3%. But the real kicker here for that real estate investor is in the depths of the recession, they were down as much as 68%. So their $1 million portfolio was down to $300,000. And I think we all know, finance and wealth management, investing, it's 20% head knowledge, but it's 80%, emotions, managing your emotions. And the struggle for those people who take those high risk strategies is, when that $1 million portfolio that you thought nothing could do to make go down, it just kept going up and up and up, dropped 70% over the course of less than a year. How are you going to react? I mean, a lot of us might sit around and say, yeah, I'm comfortable with some risk. And if my $1 million portfolio during a big market crash went to $800,000, I'll still be confident that it'll come back up. I'll still ride out, the wave. But if that portfolio went down to $300,000, there's going to come a time when you're going to have to say, stop the bleeding and get me out. And your emotions, every part of your mind is going to be telling you to get out. And unless you have the fortitude, or you just can defy reality, every investor in that situation is going to sell. And whereas that balanced portfolio not only beat the real estate investor over the course of the next 7 years, kind of caught up in terms of performance, but also had a much smoother ride. Obviously 32% is no, in terms of a drop right here, is no cakewalk, but it's much more bearable than being down almost 70%. And during the greatest, market crash since the Great Depression. And so this is just one scenario where we can show going all in on one sector on one timeline might look really good, but if we look at what happened next, it might not always hold true. There's always going to be something that's going to kind of cause that trend to shift, if you will. So let's take a look at another example, and one that I think will really ring true to where we are today. So tech. Obviously, tech is on fire now, but tech was on fire as well in the late 90s. You saw many people getting extremely rich off of URLs. You might have heard stories back in the day of people buying up a website with a popular name and being able to sell it for millions of dollars, or companies like AOL and Yahoo, funny enough, not really present any longer, that were absolutely raking in revenue due to the shift in how everyone communicated. And if we look at a tech investor, someone who was invested in tech during that time period, when the market for technology companies was on fire, they absolutely killed it. When we look at relative to their balanced investor colleague who's just kind of slow and steady wins the race, they, over the period leading up to the tech bubble, the 4.5 period leading up to the tech bubble, they were up an average of 48% per year. And in just 4.5 years, their $10,000 that they put into tech stocks only was almost up to $60,000, whereas their colleagues in a balanced portfolio had only just more than doubled their money. But, as we're starting to see a trend here, what happened next? I think we're all familiar with the tech bubble that popped leading up to the turn of the century, and how many people went from millionaires to bankrupt overnight. And so when we look at that tech investor over the next 4.5 years, who kind of put their chips all on black and really looked smart for a short period of time, well, the market went through a lot of turmoil in those next 4.5 years. We had 9/11, entry into the Middle Eastern conflict, but the balanced investors still made some money during those tumultuous times. They were up around 3% on average per year, whereas the tech investor over those next 4.5 years averaged an annual return of negative 8.7%. And at one point, their portfolio was down as much as 82%. So we just put ourselves in the investor's shoes in that real estate example of our $1 million portfolio going down to 300,000. But let's imagine, and this was perhaps a similarly quick change in terms of the market, that $1 million portfolio went down to $198,000 over the course of a time period less than a year. How are you, as the investor who decided to take a chance, going to react? Are you going to, be able to stay in there and be 100% confident when what was worth $1 million yesterday is only worth $198,000 today, and the likes of Jim Cramer and people on TV are screaming into the camera that the sky is falling, get out, sell, 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 sell. Are you going to be able to stay in there and not panic sell? And the answer most certainly is universally no. The average investor is not going to stay in. They're going to sell if they've lost 82% of their portfolio. They're going to say, I need out, stop, stop, stop. Whereas that same balanced investor, they actually made money over that next period. They didn't lose money. And they also, even during the 9/11 period and the entry into the war, were only down as much as 22.3%. A much smoother roller coaster ride and much easier to rationalize. Let's just stay the course. So let's look at one more scenario of when an investor would have looked really smart on one time period, jumping all into one sector, and how it turned out for them afterwards. So leading up to the Great Recession, not only housing was killing it, but energy was too. People tend to forget, but oil prices just kept going up and up and up, and partly because you had countries rather like India and Venezuela, these developing nations that were starting to have a lot more need for oil and gas due to more people having cars and more industry, as well as the war in the Middle East drove prices up, and oil companies drive on margins. They make thin margins, but the more expensive oil is, the more room for them to create margin and generate revenue. And so a number of factors, even Hurricane Katrina contributed to this, but oil prices were just going, they didn't seem like anything could stop them. But over the matter of less than 6 months, industry kind of came to a screeching halt. You can kind of imagine the recession in terms of industry like a train coming to a stop. It just screeched, and all of this demand for oil kind of dried up. But leading up to that recession, oil investors looked really smart. We look at an energy investor leading up to June of 2008, just before things really got frothy over this, approximately 8.5 year period. Relative to their colleague in a balanced portfolio, they were making 22% per year. And their initial $10,000 investment was more than 6 times what they initially put in. Whereas the balanced investor, they only averaged 4.2%. People tend to forget, the time period, the decade leading up to the recession, it wasn't like at least the broad market was on fire. And so that energy investor maybe sitting for cocktails with a buddy or hitting golf balls on the golf course, he would look brilliant to his colleague and might even potentially convince his buddy in the balanced portfolio somewhere around here that, hey, he needs to get in. But as the trend goes on, what happened next? Well, oil couldn't resist, the pressures of the recession. And what happened over the next 9.5 years? Well, the energy investor, he, over that next 9.5 years, lost 2.3% every year and was down as much as 64%. Whereas his colleague in that, who would have just stayed the course in the balanced portfolio while energy is getting clobbered, is going to be making 6.82% per year and have a much smoother roller coaster ride. So let's take a look next at, our next slide here. So to these investors, these clients of ours who are they want to say, hey, let's jump into tech, or let's jump into gold, let's jump all in. It seems like the place to be, doesn't it? And so let me ask you this. Tech has been on fire for the last 2 decades, I would say. We looked at the dot-com bubble, but after that, in the 2000s, we had the iPhone. We had, late 2000s was Facebook started to come to fruition. Here recently, we've even had, automotive software companies like Tesla or Amazon that have come to be behemoth companies very quickly. And so before I go to the next slide, I would ask you guys, over the last 2 decades, if we just compare the top 100 tech companies to our balanced, safe investor with 60% stocks and 40% bonds, who would have won over that last 21 years, now that we're in 2021 year, who would have won? And even myself, I would say the tech investor had to have won. Tech has just been on fire. It seems like there's nothing that could have stopped it. But let's take a look. Let's compare that tech investor over the last 21 years to a balanced investor. And the surprising finding for the investor in tech relative to the balanced investor is over the last 21 years, the balanced investors won. They've actually, if they just started out with $10,000, the tech investor ends in June of this year with 5.92% average returns and 34 grand, whereas the balanced investor actually averaged 6.74% with way less risk over the same 21-year time period. In fact, almost 1/3 of the risk of that tech investor, and he got rewarded more. Well, why is that? There's a trend that kind of plays out in the market, and we see it happen time and time again, and it's called sector rotation. And so what this colorful chart here is with a bunch of different squares is every sector of the market. You know, you can see the green down here is the energy index. You can see the red is consumer discretionary, or even the orange that's been popular as of late is information technology. But what you'll notice is there's colors all over the place. It's not like tech's up here all the time. It's not like energy's up here all the time. And what typically we see happen is whatever the hot sector is this year or this month isn't going to stay on top. Some trend's going to happen in the healthcare industry to push healthcare up, or some trend's going to happen in the telecommunication industry to push that up to the top. And so jumping all into one sector can often be a fool's errand, because you might jump into, let's say, information technology sector right here in 2009, up almost 62% in that 1 year alone. And you might say, hey, that's the place to be. I need to jump in. And what the unfortunate thing is, because you're using past data to generate future expectations, is next year, in terms of performance, technology is way down here. It gets beat by almost every other sector. And we see this happen time and time again. There's really no one sector that stays toward the top. That's called sector rotation. And what you'll find often is if there's one sector that's kind of trending for the top for a couple years, the next period it starts to drop down to the bottom. And so when we look at technology over the last 3 or 4 years, there's no doubt it's been a winner relative to the broad-based market. But we have to ask ourselves, when we start to get tempted based on past performance, we need to get in now. Well, it's been a winner for the last 3 years. We're arguing that, there's this trend called sector rotation that plays out into the market. How's it going to do next year? Already year to date, it is getting beat by the broad-based index, the S&P 500. It's already lagging. Energy, who I don't think anybody would have wanted to jump into in the last couple of years, with companies like Tesla saying every car is going to be electric, is the number one sector year to date, up 45.6% as of the end of June. So the point of this slide is to show we can't jump all into one sector, because if we cherry pick our timeline and we select a period in the past that makes one stock or one sector look really, really attractive, it's always going to beat a broad-based index over that same time period. But when we broaden our perspective and analyze how the music can't play forever in terms of that sector just keep going up and up and up, we here today have proven that a broad-based investor with a balanced portfolio that's well diversified is going to have those different levers and pulleys in place to ensure that maybe when tech's down, they have some energy exposure. And maybe when energy's down, they have some healthcare exposure. And they have a little piece of everything. And so that as the economy as a whole trickles up, they are along for the ride, but they don't experience all that pain, those negative 82% years, like they saw if they took all that risk going into one sector. And you guys might be sitting over there thinking, well, why don't I just sell before the sector goes down? You know, I look at those years. I could have sold out of tech in 1999 and walked away a millionaire. And I would ask you, you know, if you sold out of your entire portfolio on February 23rd of last year, then maybe you should pursue that strategy. But otherwise, you didn't see, much like us and the whole economy, that COVID was about to royally wreck the economy for the next at least month, and take the S&P 500 down 35% from February 23rd to its bottom. There's no way to time these markets, and these bubbles are much like tsunamis in the sense that the water starts to go out. Well, we're just, as investors, we're on the beach enjoying our time. We've been having decent returns. And especially if you're all in one sector, you can see, in hindsight, you'll see where the water started to go out. And we on the beach are kind of like, it's nothing, you know, it looks like tide's going out. But soon that huge follow-up wave comes in. And as that water goes out, you get to see who's swimming without the trunks on, who's exposed himself to risk. As opposed to the balanced portfolio where they've got some protection in play and they're prepared for whatever storm or whatever event might be thrown at them. So how do we help our clients? How do we protect our clients from being down 82% or being too heavily vested into one sector? Well, we offer a diverse investment strategy. You know, we don't try to load up on any one sector. We have a little piece of everything. And also we rebalance quarterly. So, you know, if we're in one of those eras when tech is just absolutely killing it and it starts to become too heavy or too large of a portion of our portfolio, we're getting a chance to kind of sell the winners and buy the losers, which is exactly what, you know, at the strategy that we want in place, because we're kind of selling high and buying low. And then as we rebalance each quarter, it allows our portfolio as a whole to hopefully, you know, even outperform these high risk investors. And also, we pointed out at the onset of the call that, you know, the investing is 20% head knowledge, but 80% emotions. And we kind of put ourselves in those shoes of that investor whose $1 million portfolio went down to 198,000. Now, obviously, our diversified portfolio historically has never experienced such an event, but when challenging market cycles come through, like last year, we're here to help our clients see what's going on, how this event plays out over the long run, and help sift through some of the noise. Because I think we all can admit, last March, you know, mid-March, March 16th, when the lockdowns came into effect, and we were watching the news and watching maybe even investment channels, and we were seeing market days down 6% consecutively, down 6%, next day down 6%. And we were seeing how troublesome this virus was really going to be for our nation. I think everyone was a little bit concerned, but a lot of people, a lot of investors without a team behind them sold out. They said, this is it. You know, the world is coming to an end. I need to get this money and put it in my mattress. And those investors missed out on the quick recovery that happened in the stock market. While Main Street took a little bit longer to recover, Wall Street recovered quite quickly, if you recall. And those investors missed out on some of the best days that have ever happened in the stock market. They missed that rebound. And as opposed to, you know, clients of ours who have a team behind them who are kind of still monitoring what's going on, which sectors do we want to distance ourselves from in the current timeline with this pandemic coming into play. But let's put things into reality and let's look historically. Let's examine how the market performed during 1918 with the Spanish flu. Let's examine, you know, historical life-changing events and how they shaped the market in that short run, but also how they really affected the market over the long run. And when we step back, get rid of our recency bias of being so focused on what just happened and try to look at the bigger picture, it can be a lot easier to say, hey, we're going to get through this. It does seem scary in the moment, and no one's to be faulted for feeling those emotions of fear. But let's look at the bigger picture and let's not panic. And having a team there to help coach you through that is really beneficial. And so that's how, if you're a client of ours, we get to help prevent you from one, panicking on the worst days, but also getting that irrational exuberance or that greed that affects a lot of investors and maybe jumping in all into a really risky sector at the exact wrong time. So that's all we had prepared for today. But if you have any follow-up questions, please reach out to either any of us via email or reach out to us via phone. That's what we're here for. And thank you so much for joining us today. And if you enjoyed this content as well, let us know. We want to keep you guys informed and keep producing powerful content to help you guys be confident in your portfolio and your purpose in retirement. So nonetheless, thank you for joining, and we will talk to you soon.
Hey, Matt.
What up?
Hi. Did you end it?
Not yet.
There is one question. Is it a bad time to invest in real estate?
Well, real estate is really interest rate sensitive. So, the easier it is to borrow money, the easier it is for someone to rationalize buying a home. And money is cheaper than it has ever been before to borrow. But that trend doesn't appear like it's going to hold true. Already the Federal Reserve is saying they're going to raise interest rates next year. So you just have to be mindful. We're kind of like in 1999 of the tech bubble when it comes to real estate, but that doesn't necessarily mean we're at the peak. And as long as there's still demand for housing, there's not going to be, any catastrophic event. A few good things, a few pros for real estate are more foreign capital than ever is flowing into our country today to purchase real estate. Land ownership is really hard in countries like China. It's really hard to get approval through the government. But here in the U.S., there's a lot more freedom, and it's a lot easier to obtain land. So we're seeing a lot of equity from China come in, a lot of equity from Europe come in. And so that's really shaping to help keep real estate prices afloat and push them up. Additionally, there was kind of a freeze on supply last year. Not many, even construction workers weren't able to build new homes there for a little bit. And a lot of people put a pause on their projects when lumber went through the moon, these type of things. And so there's still excess demand relative to the amount of supply out there. What you have to watch out for is, are you starting to see vacancies? Are you starting to see new developments that aren't being filled out? That's when you have to start. That's indicative of, hey, there's excess supply and potential for a bubble. So I don't think we're at a point where I would say we need to sell our real estate. We're approaching the bubble's about to pop. But the one thing to watch out for is interest rates, because as soon as interest rates go up, it's harder to get approved for a mortgage for a lot of buyers or to rationalize the purchase. It just costs more, quite frankly. And we all have looked at our amortization table on our mortgage and seen, at least in those first few years, we're essentially just paying interest. And so the higher that interest is, the more the payment's going to be. So I would say a cautious, I can't say yes or no as to should you buy real estate, just because that's a very general question, depending on your particular situation. But in general, I would say be cautious, because housing prices are up 24% year over year, and interest rates are gonna go up soon. But there's a lot of pros on the other side. So just be cautious. That would be how I would answer that question.
So be cautious in considering buying a rental property.
Yes, consider your especially cost of capital. How much is it going to cost home buyers here in the near future when interest rates go up to buy houses? And is that going to negatively affect the price the houses sell for because there'll be less demand?
Awesome. All right, that looks like that was our only question. So thank you so much.
Awesome. Thank you guys for joining, and we'll see you next time.